you're watching India Market Open. It's Tuesday morning, and of course, it was a kiss or miss on D Street yesterday. If it was Diwali, we'd, I guess, play that hand in terms of cards.
It was miss and miss.
But yeah, what a day, right? We were all betting on 25,000. We almost kissed it and walked back. And now Niraj is pointing, saying, "Aaj ho jayega."
No, I'm saying, 0.25 points is what, yeah. I mean, but yeah,
it's all about the intent.
One of those days, yeah. But yeah, looking at the Asian screen, seems like a bit of a sedate day ahead of the key rate decisions.
Correct. It's going to be a lot of wait and watch, and that's actually the mood across global markets. If you look at what's been happening in the US as well, a hunt for direction is how I would put it. So mixed trade, the Dow down in the red, not massively in overnight trade, and even futures not looking too exciting. So a lot of things, a lot of factors playing out globally as well. So you see Dow futures also down about 82 points. For one, they're waiting for the big mega numbers to come. Your major tech numbers still have to come through, Meta, etc. So that weight is on the street. Of course, the huge Fed meet starts Tuesday night our time. So tonight onwards, this two-day meet begins, and everyone's waiting for that direction and what you hear from the crucial Fed meet. What is expected, though, is more about quantum and timing of rate cuts in the remainder of the year. That's what we're expecting Powell to actually indicate in this meeting. Not so much a rate cut, that's not being expected at all. Although the street is now discounted 100% chance of a rate cut in September. So any indication that that's not quite the case could spoil the party. So that's sort of one risk factor to watch out for. The bond yields also in line with that. Bond yields actually fell slightly at 4.17% on the 10-year Treasury. Crude prices have been actually weak despite fears of an escalation between Lebanon's Hezbollah and Israel. All of that is still going on. Having said that, though, Brent was at 79.62. NYMEX is also down. So crude is okay. Asia, like Niraj said, has opened weak and is showing signs of weakness. They're also waiting for a big Q. The Bank of Japan meet is today. Slight rate increase is what is being penciled in. We'll see how that goes. But look at the Nikkei down nearly 1%. Hang Seng down in the red, over 1%. And the Nifty implied open also tells you that we're going to have a bit of a weak start. So maybe 50 to 53 points down as we open up. And that really is the mood carrying on from yesterday. The will is there to move ahead, but not the steam. And you see where the selling came in. If you pull up the fund flows, it was actually DIs buffering up the market quite robustly. 5,666 crores in buys, but FIs were selling a little under 2,500 crores, 2,475 crores yesterday. So that was the long and short of it. What I found interesting during the close as well is how you had defense and rail both spike up in the last 40 minutes to an hour of trade, especially some of those defense stocks of Mazgaon, up 10%. All of these back in action after really languishing on the sidelines. Garden Reach, all of those were doing really well. I'm not sure if you'll see more of the same. And consumption will also be in focus today with big numbers.
Yeah, one index name, a few others. Varun Beverage is almost an index name, if you will. But yeah, I mean, it's just such a bottom-up market. And by the way, mind you, I mean, volatility will be the name of the game globally because it's not just the rate calls that will happen. 40% of the S&P 500 comes out with numbers this week. So you expect fair bit of volatility at the global markets level as well, particularly the US market, so bear that in mind. So from a trade setup perspective, are the charts still constructive? The daily and the hourly charts, which is the very short-term charts, are still very constructive, but those can change course so quickly as we saw in trade yesterday. And as we saw in trade yesterday, a couple of hurdles being built at the higher levels. So on the Nifty, if you look at the 25,000 strike, the call OI added at the 25,000 strike, it's 80.65 lakh contracts at that strike, which just shows how confident the call writers are that that is a level to reckon with. We saw that yesterday. Very likely we'll not revisit that today based on what the Asian cues are suggesting. But who knows, Indian markets have a mind of their own as they showed in Thursday's trade. But 25,000, massive call OI addition out there, current OI at 80.65 is a seriously strong resistance Or if the markets decisively move up, then great opportunity for short covering. But I think the issue is with the banks, because you saw that happen in trade yesterday as well. With all the strength that the Bank Nifty has shown in the recent past, yesterday, above 52,000, 52,300, 52,400, you saw this whole pool of selling coming in, and the markets just came off. Result of the Bank Nifty pullback. Look at that chart. It just shows how weak the Bank Nifty was after hitting 52,300, 400, and that is the reason why the markets came off very, very sharply as well. From the day's high to the day's low in a matter of 5 minutes is what transpired in trade yesterday. And the pocket, aside of defense and railways and select the bottom-up names, pharmaceutical seems to be standing out. Therefore, watch out for that bucket. Continuous strength for so many days. Certainly something you want to keep a keen eye out for.
And I think, Niraj, on Bank Nifty, it did okay on Friday. So it did see a sharp up move on Friday. And I think the problem is that while earnings for banking names have been actually a clear beat on street expectations, so top line has done well, margin pressures continue to persist for the sector. And the loan to deposit ratio is still a worry point. So until we see a rate cut, it seems like a re-rating for these banking names may be a quarter away. But yes, it's going to be an interesting morning, a morning where it could be a slight downward bias, but the market still remains a buy the dip trade. Bank Nifty once again will be important in terms of trading activity. 50,700 is an important support on the index on the downside. On the upside, 52,000 first and then 52,500 is what the street will be tracking closely. In terms of stocks, we're still in the thick of the earnings season, so a couple of big names that reported yesterday, not particularly in that order. I'll start with HPCL. Numbers were largely in line with what the street was expecting. Revenues were flat. Profits, as you can see, is down 87% to report at 356 crores versus 2,843 crores. Margins were down 2.3% to come in at 1.9 versus 4.2, and EBITDA was down 56% as well. Well, now what's caused the weakness on HPCL? Firstly, the refining segment was soft, but this was largely on expected lines. GRMs, which is a gross refining margins, were also down 32% quarter on quarter at $7.4 a barrel, and the company's GRMs though continue to underperform its peers. So while the industry GRMs are weak, for HPCL it's weaker than most of its peers. LPG is also something you want to track because the performance there was led by soft margins. Marketing margins were impacted by March 24 petrol and diesel price cuts, which we saw just before we went into election season. And the company also had 2,500 crore of LPG under recovery. So weak numbers, but they were on expected lines. So no surprises there in terms of what we got on LPG. Well, ACC, interesting numbers there. The revenues were down, so marginally flat in terms of revenue. EBITDA was also down. Margins were okay. They were slightly off by about 1%, and net profit was down 22%. But what stands out for ACC is, given the current environment and the pricing environment for the cement sector, ACC still managed to do quite well in terms of volumes. So volumes have grown significantly. There's been a 10% bump up in terms of volumes. Realizations are down about 3% sequentially on a weak pricing environment. And this is industry-wide in terms of what we are seeing with regard to prices. The margins were impacted in a limited way, but of course what you want to remember is that while operationally you saw an uptick in volumes, realizations came in lower because of the way the pricing environment has been. So ACC, I don't know how the street would view this, but good volume growth, that I think has impressed the street and impressed brokers and brokerages, but of course the numbers for the industry continue to remain soft.
I mean, just one small addition on ACC, everything else notwithstanding, even if it sees a corrective move today, at $125 EV per ton, the valuations set a bit of a floor, right? Because there is only as much that a well-run asset can correct to on the valuation front when deals are being struck at $110, $120 EV per ton.
Right, actually, with everything happening in the South Belt, these are the guys who are the listed big daddies in the business. And of course, they own 23% market share. Let's not forget that. So it's significant in an industry that is a big ancillary to play the India story. So ACC is one you want to track in early trade. Not too many brokerages have come out with their calls yet, but we'll wait and see as and when something comes out. But for now, I think what we've seen is Citi has maintained their call on it. Jindal Saw was a good set of earnings. Again, we were the street was quite excited even ahead of the numbers. The stock went in with a 4% gain. Yesterday, revenues were up 12%, EBITDA was up 38%. Margins have improved significantly. So they've come in over 4% high for the quarter at 17% versus 13.8%. And net profits was significantly higher, up 70% in this quarter for Jindal Saw. Well, while the margin stood quite strong, EBITDA also improved. Their order book also is looking quite healthy, and execution seems to be roaring for Jindal Saw. So they've been very good in terms of execution, and despite that, their order book stands at 165 crores versus 153 crores. So all in all, I think it's going to be a very clear thumbs up on Jindal Saw. Good earnings, brokerages seem pleased. While I know expectations were running high, but they've performed and kept up to what the street was expecting.
And Samina, I mean, these are businesses I think street might want, because 11 times trailing 12-month earnings.
How
and a profit growth of 70%, right?
So, and no exceptional items. So this is actually operationally good business that you can. But also when I track this, Jindal Saw quarter on quarter has been doing really well. So I don't think it's come in as, I mean, the street is not going to be surprised in that sense, right? Last quarter was also solid. And this quarter is again a clear beat. But all in all, we'll still give them credit. They still deserve to be mentioned that it's a good business, operationally looking fantastic. Order book looks healthy. Their Middle East business is also picking up and looking quite well. So Jindal Saw, big gainer. ACC will be a buy the dip strategy, I would expect. And HPCL industry is not looking great, but who knows, lower crude prices sentimentally will help HPCL again this morning.
It's a bit negative though, I think, on HPCL, simply because, you know, it just underlies how vulnerable they are to policy decision. I know it was pre-election rate cut.
The hope is they have 5 years to go through this again, hopefully.
State elections are coming. So this can happen once again and time and again. So I think it just underlines that. HPCL overall, not good numbers, so you might see a bit of pain point there. All right, just let's look at a few more. Colgate Palmolive on my radar. Numbers are pretty decent actually, and I think the big highlight is they're seeing rural markets outpacing urban markets second quarter in a row consecutively. We spoke to the management last quarter also, and they talked about that slight turnaround that's happening again. So rural markets have outpaced urban markets. The toothpaste business has posted double-digit sales growth driven by high single-digit volume. So if you compare it with, say, an HUL, you are doing better, because HUL oral care revenue growth was mid-single digit, driven by pricing. Toothbrush segment has grown in strong double digits as well. Let me just tell you what houses are saying on this. Nuvama has maintained a buy and actually raised the target price for Colgate Palmolive to 3,745. So good call there on CP. They're saying that they started to gradually benefit from the likely rural recovery, and they anticipate balanced growth in FY25 versus pricing-led growth in FY24. Citi, meanwhile, has retained a sell. So you have two different views coming in there with a target price of 2,850. The belief, while there is an opportunity for growth in consumption, Colgate India seems to be investing behind this, and they estimate moderation in margin expansion going ahead. So two different views, definitely, but on the face of it, the numbers do look pretty decent. Quess is the other one that's on my radar, and we'll be speaking to the company also later today. Quess actually has seen a revenue push and a profit push from their staffing segment, which is one of their biggest segments. It's also a good gauge for where we're going in terms of hiring coming in. Remember, Quess could be one of the benefactors of the many employment schemes that the government has talked about in the budget, although their EBIT and EBIT margin is slightly down. Overall, you would say it's a strong quarter because their largest segment, which is staffing, has done fairly well. RVNL is one that I wanted to put on your radar simply because of the kind of move that stock saw yesterday after languishing fair bit over the last few sessions. So there is news coming in, 739 crore order. They've emerged as the lowest bidder from the Himachal Pradesh State Electricity Board, and the order will be executed within 24 months. Now, this could have possibly been the trigger for the hike up or the spike that we saw in the RVNL stock yesterday. We'll have to wait and see if you see some pullback today after that jump up. We closed on a circuit, actually, 10% up.
Yep, so watch out for this one and an order win. Since we're talking of order wins, I'll highlight one more order win, and that came into ITD Cementation. Actually, credit goes to Anushi, who highlighted this yesterday, but they've received an order worth 1,237 crores. So watch out for ITD Cementation. Both RVNL and ITD Cementation are order win candidates. So that's to be watched out for. I will watch out for data patterns. Interesting numbers. Revenues were up 16%, 104. The estimates were 108. So no surprises there. But there was an expansion in margins for data patterns. 35.7% versus 31. That's a big bump up. And relative to estimates as well, 32.9 was the estimate. They've come in at 35.7. As a result of which, a 27% uptick in PAT at 33 crores versus 26. Now, this is not a cheap stock, but it's delivered on the margin front, which is good news. So maybe see a bit of a reaction for that one. And then Pfizer is interesting. Again, very good set of numbers relative to estimates. Revenues were flattish, so that's fine. But on the margin front, versus 20.8, they've clocked in a 31.5% margin. The estimate was 30%, so they expected to do well. They've done better, as a result of which PAT up 61% at 151 crores versus 139 crores. Now, the only or the fly in the ointment is that it's an expensive stock, and a lot of its supplies are resuming this year for Pfizer, but the growth expected across the analyst community is mid-teens. So for the kind of premium that it trades at, maybe mid-teens is just about right. So may not see too much of a further reaction after initial bump up. That too, if it does. But remember, pharma is in a good space. Pfizer has delivered good numbers. So who knows? May do okay.
Just a quick one on the stocks I mentioned. I'll just highlight a couple of brokerages that have come in. So on ACC, Morgan Stanley's equal weight. They seem impressed with volume growth, and they also believe that fuel costs did better than expected. And also Jefferies actually is a buy call on ACC with a target price of 3,045. They do seem quite impressed with ACC as well. On HPCL, Jefferies maintains an underperform on HPCL, and Citi has got a buy. But let's also remember that yesterday there was an aggressive buy call coming in on the oil and gas pack by UBS, which led to some of these stocks being higher. Now, today, of course, you've got earnings on HPCL. So you've got one positive report and one not so positive on HPCL. So ACC's got two positive calls, and HPCL is one negative, one positive.
Yeah. Just a few more that I want to talk about. Since we talked about RVNL, I must mention RITES, one of the top gainers yesterday, and a phenomenal jump up for RITES as well. They have this tie-up with NHAI. It's a comprehensive consultancy with NHAI, 14% up on the stock yesterday, and it was just flying right from the start. Would be curious to see if it sustains momentum. I'll talk about restaurant
also
brands.
On RITES, there is a board meeting tomorrow to announce the bonus issue. So in 2019, when they'd done it, it was 1:4. We'll have to wait and see what comes out tomorrow. So that could have been the added reason why RITES got a little bit of...
You might see a bit more of a leg up today as well. So RITES you should keep on your radar. I'll talk about Restaurant Brands Asia, because even though they have a net loss of 52 crores, it's actually better than what's expected. And this is a bit of an improvement. This quarter is not half bad for them. Revenues up 5.9%, EBITDA up 30.7%. Margins have improved as well from 7.9 to 9.8. And the Bloomberg estimate for their net losses was 82 crores. So the fact that their net losses are at 52 crores might just be a positive for Restaurant Brands Asia. Not so much for a Kalpataru. Revenues are up 8%, but margins have slid from 9% to 8.2%, and net profit was also down 25.7%. I think just future projects will not cut it too much anymore for real estate companies, which have been under a bit of pressure. So, yeah, those are some of the other stocks that you need to look at this morning.
PNB Housing Finance could be a big one. So we spoke to the management yesterday and kind of asked them about this possibility, but it's come out to be true. Carlyle Group is going to sell up to 6.4% stake today. There's no guidance on pricing given, but suffice to say there might be a bit of a pullback on this one if indeed it's done at a discount. Usually these things are done at a discount. So don't quite know how it behaves post that, but watch out for this large block. 6.4 is not a small one, so that's to be one to watch out for. There is BEL that you should watch out for after the numbers. Most brokerages have come out constructive. Jefferies, for one, has a buy with the target price raised to 370 versus 305 earlier. They say that the 76,000 crore order book provides revenue visibility, and the pipeline of orders over the next 3 years at over 50,000 crores is strong, with export orders a bit of a surprise element. So do watch out for Bharat Electronics as well. Could be an interesting one in the session
Just
today.
on BEL, UBS has actually downgraded it to a neutral because they say that its 12-month forward PE of 48 times leaves little room for a positive surprise. Their target price is still 333, down from 340. So the valuations and the kind of run-up is a bit of a pain point as far as UBS is concerned, just on Bharat Electronics.
Good to highlight both ends, by the way. So keep this in mind, and whichever brokerage you might believe in, or if you do your own result due diligence, then that. But speaking of due diligence, Alex, couple of pockets need some good due diligence, because one is shown some fantastic quarterly performances. The other one not quite so.
Absolutely. In fact, I'm going to invite Samina to join us, because there's two pockets of companies that we're talking about, as Niraj pointed out, on the editor's cut today. And in case you're tuning in for the first time, editor's cut gets you the story behind the headline. And we're talking about a group of stocks, all of which, most of which I should say, barring a couple of exceptions, have gained at least 40% or more in 2024. And the reason is what we're going to try and understand and help you understand as well. We're going to talk about oil marketing companies first. Of course, it's in focus on account of earnings, HPCL to break down today. But there's also more about the outlook for FY25 and whether the valuations currently price that in. And there's also the wealth managers, which had quite the day yesterday, and they've had 2024 to remember so far, at the very least. We'll talk about why that is. Sajit, we'll start, and Samina, with your permission, we'll start with OMCs first. So you've looked at a comparison between FY24 and the factors that worked for these companies then and FY25, and there are a lot more crosses on the list in FY25. I saw this in your cheat sheet.
That's true. Let's look at the PSU oil marketing companies, and most of them have doubled in FY20 in last 12 months, and the PSC index is also almost more than doubled actually in that. So that has been an outperformer in FY24, to set the context. And what was the reason behind it? One, they were there was a favorable gross refining margin, which basically meant that their cash flows were very much positive and very improved there, and that cash generation helped them not only in reducing their debt on a gross level, but also helped in the capex and also in the dividend payout which came in. These 5 items were the key drivers for oil marketing companies, or PSUs basically, especially because they are the ones which get influenced by policy decisions there, and that was a big run for them. Things have changed in FY25 as we speak. From a global level, gross refining margins have bottomed in Q1 of FY25. They hit a bottom of 5.4, if I'm not wrong, in Singapore GRMs.
Versus plus 7% in the fourth quarter.
Yeah, it was 6.6 average for FY24, and Q4 it was 7.3.
Yeah, okay.
Many of the PSUs which had average GRMs of 7.5 to 9. BPCL had a higher GRM, HPCL 7.5, IOC in the same region. Those GRMs have taken a hit in Q1.
Sajit, a quick aside, just so that everyone understands, why are gross refining margins so important?
Basically, these are the margins at gate level, because when you process a crude and at what price you sell, that the differential is the margin, and that basically gives you the cash flows as well for a refining company.
Obviously, higher the better.
So the higher the margins, it's better. It's benchmarked to Singapore GRMs, and normally Indian refiners have a $2 to $3 premium to Singapore GRMs. That's thumb rule to follow.
But going back to your list and things that are not working, the capex cycle is the only thing that continues. Everything else is negative.
True. So in FY25, if you look at most of the brokerages are talking about the fact that there is going to be weak GRMs. We have seen Singapore GRMs bottoming out in Q1 of this year to $5 or so. and that impact is witnessed in many of the oil PSUs as well, where they have been talking about 5.9 to 7 kind of GRMs compared to 12 and 14, which in many cases which they did in some of the quarters there. So the GRMs on an average will be lower by 20% or so in FY25 compared to FY24. That would lead to a lower cash generation for many of the companies. The good trend that we saw in FY24 was that most of the PSUs were reducing their debt levels on a gross basis. That's going to come down further. There is a price cut in petrol and diesel which happened in March ahead of the elections, and also an LPG cut which happened. That reversals are not going to happen very soon, anytime soon in FY25, because we have 3 major state elections coming in, and that's not going to happen. Under recoveries are to the tune of 600 crores per company per month, which we are talking about. If you just look at IOC, BPCL and HPCL, we're looking at 20 to 24,000 crores of under recoveries in LPG alone, for which nothing has been provided in the budget. And the street is expecting, or the analysts are expecting, that maybe in the second half there will be some provisioning. So far there's nothing in the budget. So what comes in the second half is totally different there. The capex cycle is the only one which is continuing. HPCL has been raising debt for its Rajasthan project. BPCL is looking at a greenfield refinery, and there's a Bina refinery expansion which is there, for which capex is there, and same is the case with IOC, which is there.
What's the bottom line, Sajid?
The bottom line is that 25 is going to be an underperformer year for oil PSUs, and if dividend play was one of the things which was in favor of them in FY24, that's going to be lower in FY25. So, from a fundamental point of view, from cash generation point of view, and from a dividend play point of view, it's going to be a muted year for the entire oil PSU basket.
With some major question marks that are yet unanswered, the point that you made on under recoveries.
Under recoveries.
All right, so we've talked about that, and possibly valuations from that perspective stretched. Agreed?
It's going into the year, seeing the kind of performance in Q1, it's going to be a stretched valuation for many of them.
Talking about a sector that many have called all-weather, because ultimately everyone wants wealth to grow. Wealth managers have reflected that. The valuations have grown. But what are the factors that are leading to this kind of insane outperformance?
So I think for good reason, right? So you mentioned, let's start with how the stocks have done. You said how they did really well in trade yesterday, and just to put numbers to that, in the last 6 months, so I'll take this between Nuvama, Anand Rathi, Motilal Oswal and 361 WAM. So those are the 4 big players in the listed wealth management space. Nuvama is up 70% year to date. You've got Anand Rathi that's up 22% year to date. 361 WAM is up 70%, and Motilal Oswal is done 40% year to date. Now you would imagine that some of these counters, unlike OMCs that have done really well, like Sajid highlighted, the outlook may not be as promising. Contrary to that, in the wealth management space, this is a young industry still, right? We've talked about how the number of accounts that get added in the product side, financialization, the first key beneficiaries apart from the exchanges or also wealth managers. Now, to put out numbers to it, Knight Frank put out a report early this year talking about how they see the affluent HNI segment growing in the range of 7 to 12% over the next 4 to 5 years. Not too many brokerages, remember, cover this sector because it's like covering your peers. So we don't have too much in terms of brokerages sales. But Jefferies believes that the CAGR for the likes of a Nuvama, Anand Rathi, Motilal could be in the range of 20 to 22%, which means they're going to be doubling down every 3.5, 4 years. If you look at that, that sounds pretty promising, right? Because this is a business that is growing significantly. Now let's take you through what's working for them and how the industry dynamics have changed in the last few years. One, the upfront fees that a lot of these wealth managers was focusing on has been gradually coming off. Now that could be thanks to the regulator, which is actually a good thing for some of these firms. And now what you're seeing is these organizations are earning on trail income. Trail income is what you get when you encourage or when you have an investor who's invested in a mutual fund, for example. Mutual funds pay out a fee. And that trail income is generally sticky because even if a market is doing okay, if the fund is not underperforming grossly, that income usually lands up staying with the distributor. So trail income has gone up. The other thing these businesses are focusing significantly on is also building up the advisory model. Now, this is a relatively new concept in India. Not too many firms do it in the listed space. The few that do it are, of course, bulking that up as we go along. With advisory as well, generally that piece is sticky because you don't earn on what you're selling, you earn on what you're advising. So you largely act as a consultant. And as your clients' assets grow, the
as
fees that you earn simply grows.
It's a percentage, right?
Because it's a percentage of assets that you manage. So you've got increase in advisory fee. Advisory fee is also a big input that goes into average recurring revenue. So that is revenue that just keeps getting bumped up year on year. You may add a client this year, their wallet share increases the following year, you add new clients, and you just pretty much keep carrying on, right? And working on the base that keeps getting higher. So average revenue rate was about 40 to 50% 3 years ago. That stands at 60 to 65% and is expected to go up to 75 to 80% by FY26.
And the stickiness of that is quite significant.
It stays, it doesn't go. The other thing that's also worked for the sector is the number of IPOs. What we forget is a lot of people in the wealth advisory space also land up selling unlisted equities. The fees on unlisted equities is also fairly significant. So that too has contributed to their performance, generally speaking. Apart from that, a few factors that I saw that has been laid out in Knight Frank's report is the ultra HNI segment is poised for growth because we are at that cusp where previous generations have made significant wealth. So intergenerational transfer is currently taking place over the next 3 to 5 years. You've also got increased interest in complex products. So all this talk about financialization, increasing household savings, operational efficiency, spending better, millennials who don't really want to invest in, physical assets, they prefer financial assets, is all going to help the sector. And now people want to invest even internationally. So these are complex products that Indians are interested in, which helps fund wealth managers such as this. And also evolution from a pure play physical interpersonal to tech getting involved, right? Tech is also changing the game. I mean, I don't know if you know, but you saw the kind of valuation Deserve got. It's a pure play advisory on tech. So that's the other big positive. Now, while all of this is great, we know the stocks have run up. Just to put this in perspective, they don't actually come very expensive.
Oh, okay.
Interesting, right? So apart from Anand Rathi, which is an outlier, it's at 63 times price to earnings. But remember, Anand Rathi in the last 1 month has actually corrected.
Yeah.
Which goes to show you that the markets have seen this and they are ensuring that that valuation comes off eventually. Yeah. The guys that look good and have done really well is Nuvama. So Nuvama's stock performance has been phenomenal and it's actually very well priced. It's priced at 29 times, which is not too expensive. Markets have recognized that. The stock has gone up. So I think we're being very mature in how we are treating these companies very independently. 360 VAM is expensive, 48 times, and you've got Motilal Oswal that hasn't done very much because they've largely been a brokering business, right? So they're still in that transition phase of saying, we are a wealth manager, we are looking at private banking, it's the ultra HNI. So they're available cheap, and if I had to put a bet on this, I think Motilal may be the next big thing because the growth that they're anticipating is not in the price just yet. So,
and just to add, a lot of brokering firms are now looking at wealth management as one of the verticals. Angel is looking at one because they're going to see a dwindling brokerage income coming as impact on F&O is going to come in. There's also a new thing which is going to come in, the new asset class, which is between about 10 lakhs. And I'm sure a lot of wealth firms would be targeting that license. So because between 10 and 25 there's a big gap. And
10 and 50, Sajid.
25, 25 for PMS and 50,
no, 50 for
PMS. So 10 and 50 there's a big gap, and that big gap
plugged in.
Is getting plugged because there's an informal market which is getting formed for
which
that.
Which will get regularized now. Also, I think the fact that wealth, like you said, is really where the alpha is because this is sticky money, right? Only going to get bigger and better. Unlike brokerages, which is thin margins, it's a heavy top line business, but margins are paper thin. Is also, I haven't read this, but this is what I've been hearing. You also the new rich in India now. Yeah. There's this new emerging segment where there are people who've gotten wealthier. All these people who made money over the last 3 to 5 years in the equity markets, even if there is a downturn, so I think what they very commonly say is that for a wealth manager, the best times are in a downturn.
Yeah.
Because when things are looking great, everybody thinks they can beat the markets.
Absolutely.
It's only in a bad market when wealth managers actually start picking up clients on the go. So
and that's what a worry for the regulators as well, right? Of the household savings
have been dropping,
dropping
And
from
that is a conversation.
Equity and mutual funds have gone up from
And that is a conversation for another day. I think we've talked about wealth management, and you let us know what you think about the potential for this business, whether it's in the price and what you would be picking up. We have to slip into a very quick break. On the other side, F&O set up before the start of trade, and will we hit 25,000 is the question that we're asking. Do stay tuned.
Welcome back. This is India Market Open. We are taking stock of the futures and options space. Well, yesterday was a day of trade where we actually did see the Nifty flirt with the 25,000 mark. We really didn't see it hit it, but it was nearly there. The question really is that over the course of the next few sessions, can that actually come through? But while that happens, well, let's take a look at what happened yesterday. Well, we did see the Nifty closed flat, marginally in the green, very little change in the futures open interest. The Bank Nifty further unwinding coming through. In fact, the open interest declined by another 15%. And at the moment, just about 65,000 odd shares in open interest for the Bank Nifty. It's a relatively lower number. It does also mean that perhaps participants are a little bit more hesitant at this point in time to take any positions as far as the Bank Nifty is concerned. You never know how things could change over the course of the next few days. Well, when it comes to your overall open interest distribution picture, remember that even before yesterday, we had a considerable amount of writing around the 25,000 strike, the 25,000 call. And yesterday was a day where a lot of traders took that as an opportunity to go ahead and sell more, considering the Nifty's failure to climb that mark up. But that also means that if and when the Nifty does go above that mark, the short covering on those calls will just be as strong, and hence the up move then will also be a lot sharper. So these are some of those factors that a lot of participants may want to keep in mind. Naturally, and perhaps unexpected lines, we saw a lot more writing around the 24,500 and 24,600 puts as well. But that's as far as your Nifty open interest distribution is concerned. We also are looking at the Fin Nifty weekly options expiry, keeping an eye on 23,500. Let's talk about stocks then. And we have longs in Sun TV, Gujarat Gas, and Coromandel International. And among stocks which saw unwinding, let's pull that up. We have short covering for Bandhan Bank, ICICI Lombard, and AU Small Finance Bank. So mixed cues coming in. The question really is that where do we go from here? And are there opportunities that we can in fact look to take advantage of? Well, for that, we have Ajit Ramya of Ajira Ventures who's joining us on the show. Ajit, good morning. Thank you so much for joining in. You do have two stocks on the radar, but I want to talk about the first one, which is, I believe, from the banking space. Can you take us through that particular strategy that you're playing as far as option goes?
So we find banking stronger. So we have a sell call on Axis Bank. So over here we are bearish on this counter, and overall, due to the overall negative sentiment in the private sector banking, we can clearly observe the counter to correct in the short term. So we can initiate a strategy where we sell 1 August future at 1178 and safeguard it by buying a 1220 call at 14 rupees 15 paise. So we have a target for Axis Bank placed at 1100 and also have a defined loss, all thanks to the hedge in the strategy.
Okay, we do know that Axis Bank has weakened substantially, especially after its earnings have come in. And in that case, as you can see the strategy on your screen there, Ajit is looking to largely go short on the futures and also buy a 220 call, to hedge your bet to a certain extent. This will, of course, run through the month of August. But Ajit, the other one on your radar is also one from the pharmaceutical space. How are you playing that one?
So we are bullish on this counter. This is Dr. Reddy. So it came out with very good results on 27 July. It has also declared a stock split in the ratio of 5:1. These factors are making it favorable to investors and traders. So we initiate a bull call spread where we buy one ATM call of 6850 at 172 and sell our target price of 7250 call option at 43 rupees. So total cost of the strategy is 129 rupees, earn a total gain of 400 rupees. So over here, we urge the investors to stay invested, but shift to defensives like pharma and FMCG. And we find the banking sector to be weak, so one can short over here.
All right. So there you have it. That's one call played for the downside and the other played for the upside. That's Axis Bank and Dr. Reddy's, respectively. Ajit, on that note, thank you for joining us and taking us through these two option structures that you think could work out well as far as markets are concerned. We'll continue to give you updates on that one as well. And with that, it's back to you all.
And thank you for that, Agam. That's, of course, a quick check coming in on the F&O market. A check on implied Nifty as well before we move on and get some perspective from our guest on what trade is going to look like this morning. 57-point cut is what we're expecting in early minutes of trade. Rajat Bose, SEBI-registered research analyst, joins in with a technical view on the markets. And we've also got Sunny Agarwal, head of fundamental research at SBI Cap Securities. Rajat, I'll start with you. Good morning. What is the call on the Nifty? Contrary to most analysts, the Nifty has managed to gain and reach levels close to 25,000. This morning, there could be a buying opportunity. Would you encourage traders to go long on the index around 24,900?
See, first of all, Nifty yesterday ended flat. It opened higher and then almost touched the 25,000 mark. And after that, closed at around, say, 24,836. Now, On the downside, I would say that 24,600 to about 24,450, it's a very strong support range. So long as this is not broken, any dip can be bought. Or if it were to go up, then also you can buy, because the resistance will come from 25,000. Now that is a high as well as a landmark figure. And then from there, a Fibonacci level is around, say, 25,111. So I would say 25,000 to 25,150 might act as a resistance. But telling people, see, I have been circumspect about the market going up, but whoever is giving caution, be it Ramdev ji or say Mr. Narayan, it is not really working because there is too much money there in the system. So at dips, I would suggest buying. If regarding Bank Nifty, I would say that if it manages to cross 51,450, only then a long position would be warranted, putting a stop loss below the 51,000 mark. But in case of Nifty, so long as this level of 24,450 is not broken, there is no such threat for further downswing. And even if a downswing were to happen, 24,000 to about 23,800 is another major support area. So long as these levels are not broken, any move down on the downside may not sustain, however much we crib about the valuation or whatever that is. So let's ride the rally, that kind of a attitude we should have.
With that attitude of let's ride the rally, Rajat, very good morning to you. Tamanna here. What are the top picks for the day? What are the kind of sectors or stocks that you would be looking at?
See, I would be giving two short-term buy calls. First one is IRCON, Indian Railway Construction. IRCON closed at 299. IRCON had a corrective swing in the recent past, and only yesterday it has given a green candle that is actually showing that there is another upswing cooking up. So I would put a stop loss at 291.50, 310, 317 and 323. These are the three targets. Mind you, this is not an intraday call because I don't give intraday calls at all. This is a short-term call. And the other one is a stock that is already on an upswing for quite some time. And it's a mid-trend entry. Again, it is a short-term call. It is Bata. Bata closed yesterday at 1629. And its targets on the upside would be 1645 and 1658. And the stop loss should be placed below 1616. Both these two are short-term calls. I personally do not have either of the two stocks, but Bata I have recommended to my clients some time back, so they might be having it.
Okay. Rajat, good morning, and a word on some of those defense names that really perked up in trade yesterday. Now, the world calls them expensive. They get bought at every dip. What do you do with a HAL, a Mazagon Dock, or some of these others, which along with the railway names showed a bit of a spike yesterday?
See, Niraj, I would, first of all, good morning to you. I would like to say one thing about defense stocks. Yes, defense stocks have gone way beyond any imagination, and they are still doing well. The point here is that HAL, Mazagon Dock, and Cochin Refinery, if these three you consider, I would say this is the first basket. These are the lead counters in defense. So here, if we apply market cap to order book, all these things may not simply work, because people who want to buy defense stocks will be moving into stocks like HAL, Mazagon Dock, and Cochin Refinery. So what I see here is that for the last 3 days, HAL has been moving up. It has crossed 5,000 again. Now the 20-day moving average that is located around, say, 5253. That will be the first target to look for. And unless it falls below, say, 4,800 or so, there is no such threat as such. And chances are that it will be a trading range-bound activity that can happen. See, maybe HAL, Cochin Refinery and Mazgaon Dock will do what, SRF did for the last couple of years. Now they might become range-bound because people are willing to buy defense stocks at any price, especially the lead ones. Mazgaon Dock yesterday has given a fresh new high, and the kind of strength it is showing. And just like IRCON, it has also signaled the end of a short-term downtrend. It closed at 53.40. It can once again go to 56, 5700. Only when it crosses 58.50, then you will see further gumption coming into it. But we cannot say that it is too highly valued or something and you should not participate. See, these are the lead stocks, so there will be buying so long as money is available.
Right, of course. Okay. So Rajat Bose qualifying some of these as lead stocks. Wonder if Sunny Agarwal concurs there fundamentally. Sunny, good morning. A bunch of these stocks have delivered some very strong numbers as well. We are going to be talking to Zen Technologies, for example, today. It's been an upper circuit for last 3 days because of a blowout set of numbers too. But yesterday, a spike seen in some of these names. Are you a buyer fundamentally to any of these defense names which are trading at anywhere between 50 times to 90 times?
Yeah, good morning, everyone. Thanks for having me on the show. I think within defense pack, what I feel that one round of re-rating has already happened during the last 2-3 years, where we have seen P multiple expansion from close to 8 to 10 times to now more than north of 40. Now within defense pack, what I feel is that companies which are likely to deliver a healthy earning growth, case in point, Zen Technologies, where we have seen a very robust execution. At the same time, a foray into the new products, like they have recently launched 4 new robots also, wherein that will start contributing to the top line over the period of next 2-3 years. So I think expansion of product basket, expansion of geography, earlier Zen was predominantly domestic focused company. Now they are targeting export market also. So I think companies like Zen, for that matter, Premier Explosive, where we have seen a very robust order book and expecting a good execution over the period of next 2 years, led by increase in demand for explosives. So I think a small size defense company, private companies like Premier, Zen, yes, definitely I will be buyer on deep. Where the earning growth will be north of 20-25% over the period of next 2 years. And within the PSU pack, I would like to stick to a larger players like HPCL and BEL, where we are expecting a consistent earning growth over the period of next 2 years. However, the return expectation need to be toned down. I feel the fair value of HAL is close to 6,000, 6,500. BEL may be close to 370, 380. So expectation in terms of return need to be slightly toned down on PSU defense basket, especially on the large cap like the HAL and BEL.
All right. In fact, some more stocks that you should keep an eye out on in today's trade because of the Q1 earnings and other factors, of course. Anushi is joining us with more details. Anushi, what is on your list this morning?
Hey Tamanna, so the first one on my list is Colgate Palmolive. Now the company has reported a 13% of a revenue growth, so it has beat the Bloomberg estimates of about 1,429 crore a year. If you look at the EBITDA, it has seen about a 21.6% growth, while the margins have inched up to 34% as compared to 31.6%, again beating the Bloomberg estimates of 33% of a margin. Net profit also saw about a 33% growth. But in other key highlights also, the domestic sales registered a 12.8% growth, while the toothpaste category saw about a high single-digit volume growth. Now moving on to Pfizer, this has reported a 5.9% revenue growth, but it's the EBITDA and the EBITDA margin which clearly stands out. 60.3% of EBITDA growth, while the margins have moved to 31.5% as compared to 20.8%. Now this EBITDA uptick that we are seeing is led by cost of raw materials declining by about 32.9% year on year, as well as other expenses seeing about a 16.1% decline. Net profit in as a result of this has seen about a 61% growth. And the last one on the list is Data Patterns, revenue about 16% growth at 104 crore year. This was lower than the Bloomberg estimates of 108 crore, but it's the EBITDA and the margins which make up for this. EBITDA about a 33% growth. And margins moving up to 35.7% as compared to 31%, again beating the Bloomberg estimates of 32.9%. Now, if you look at the order book positioning of the company, order book stands at about 1,147 crore as compared to 1,083 crore in March 24. So these are three key stocks that we should be watching out for trade today.
Right. Sorry, I just wanted to add this Jefferies note on Colgate because Anushi spoke about it and they're very, very positive. They've put in a buy rating with a target price of 3163, saying when it rains, it pours. The Q1 they see as a beat, and they're saying a confluence of macro factors like pickup in rural along with strong execution has helped Colgate to drive an impressive growth in revenues in Q1. So just that word on Colgate. This is the third straight quarter of upgrades for Colgate from Jefferies. So just quickly, we'll get a view from Sunny on that stock since we've been talking about it and whether it could pay an interesting play when, the whole consumption defensive story has sort of slid back. But Colgate numbers indicate strength.
Yeah, very strong set of numbers from Colgate, especially from a rural belt where we have seen a consistent two back-to-back quarter of outperformance by rural belt as compared to urban. And I think there are multiple levers still available for Colgate, like pushing for oral hygiene 2 times a day and so on and so forth. And I think during the last one and a half year, the competitive intensity has also reduced significantly, especially from players like Patanjali. So I think yes, still there is a long runway in terms of growth. Maybe a kind of mid-teen kind of sales and profit growth is something which one can expect from a Colgate over the period of next 2-3 years. Yes, definitely would like to add in the portfolio, defensive portfolio from a medium to long term perspective.
Sunny would like to add Colgate in the portfolio. What about you, Rajat?
See, both Colgate and Pfizer that you had been discussing, I noted one thing. Say, in case of Colgate, the last correction that ended around 26th of June and the very next day, 27th June, there was a huge volume figure, and that showed the beginning of buying, anticipating this better performance this time. And one thing that I've seen on the technicals is that either the stock hits the Bollinger Band upper band, and then there is some kind of a profit taking. That is what has happened yesterday. But so long as it doesn't fall below, say, 3100 mark, Colgate can still see some more buying. And on the upside, the target would be 3300 to about 3330. And regarding Pfizer, what I would say is that Pfizer is also, Pfizer in fact is even stronger, and it is within the Bollinger Band. So there is still every possibility that this stock can again move further up from here. But here also, a few days back, that kind of heavy volume that signaled that the performance would be good, and some people have started buying, anticipating that. So anybody entering Pfizer or Colgate now, unless it is a long-term bet, this is a mid-term entry, mid-trend entry. So one should be very careful about where to put their stop losses.
Okay, so just be careful about this as a mid-term sort of mid or long-term kind of bet. Very quick break. We're coming back with the pre-open rate. Stay tuned.
right, back with India Market Open right here on NDTV Profit. 30 seconds left for the markets to kickstart trade. And keep in mind, it'll be interesting to see what some of the result reactions are, particularly on stocks like HPCL and ACC, because some of those have cornered numbers which may have a bit of a wobble, but the valuations work well. So those are the things we want to keep in mind. Here are the first rates, and these rates will change, but just to mark them cursory, showing a green, I really doubt it'll stay that way. But like we said, a lot of stocks which should be monitored in the session today on the back of the numbers. The pipe companies, Sunny, Jindal Saw, Maharashtra Seamless, completely contrasting numbers that have come out. But in Jindal Saw's case, margin expansion, PAT expansion, trading at some 10-11 times. Is there merit to look at the pipe companies like Jindal Saw?
Yes, definitely. I think all these pipe companies are driven by the strong push by government on a Jal Jeevan mission. So I think especially companies like Jindal Saw, which is trading at a very reasonable valuation, 10 to 11 times price to earning multiple. And we have to keep in mind that usually 1Q is a seasonally weaker quarter for all these pipe companies. Quarter 3 and quarter 4 are seasonally strong quarter. And in addition to this pipe, I feel the structural steel tube industry, which is catering to infra companies, companies like APL, Apollo Tube, for that matter, Venus, High-Tech, all these companies are also well placed based on robust infrastructure spend. So I think, yes, volume growth is something which will remain healthy over the period of next 1 or 2 years. Obviously backed by spend on infrastructure and government schemes like Jal Jeevan Mission, increase in pipeline infrastructure for oil and gas space. So we continue to remain bullish on entire structural steel tubes as well as pipe segment for next 2 to 3 years.
Rajat, remember that we talked to you about bank, Nifty and banking stocks. Any trades in this universe?
Regarding HDFC Bank, I would say that you can have a short-term long side play here because it has reached a support area, although it failed yesterday, but unless it falls below 1583 or 1580, any dip one can buy, and one can expect a move towards say 1640. It's a very short-term play. Otherwise, I'm not very keen to play the banks right now.
What about you? Fundamentally, are you buying into banking names? The numbers were really good. Most of them have shown growth on the top line, but LDR still a concern for the sector. Sunny, fundamentally, how are banks looking? Are you buying into any of those banking names? A lot of them were on a tear yesterday.
Yes, so I feel the entire banking sector is going through slight trouble on asset quality front. So we have seen unsecured lending book. There we are seeing some spike in NPAs. At the same time, NIM is coming under pressure for entire banking sector. Maybe one more quarter 2 will be another quarter where we will continue to see a moderation in terms of NIM. And once there is a possibility of rate cut by the global central banker coupled with RBI, I think the pressure on NIM will reduce maybe starting in the quarter 3. Within banking space, selective banks have outperformed in terms of performance. So banks like Federal Bank, Karur Vysya Bank, these are the 2 banks where we have seen a relatively better set of numbers. Indian Bank yesterday reported a decent set of numbers. Compared to bank at current juncture, we are more bullish on NBFC as a space and would like to bet my fresh capital in NBFCs like Chola, Shriram, Bajaj Finance, because what we are seeing in banking sector, there is a lot of regulatory tightening, which is also likely to play out over 2-3 quarters. So I think at a current juncture, relatively NBFCs look better placed as compared to banks.
That's the word coming in on banks. So you've got a whole bunch of other companies as well that will be reporting earnings. But very quickly, Rajat, we talked about banks. Let's talk about wealth management companies. So Nuvama, 361, Motilal Oswal, and All these three, Anand and Rathi, all did quite well in trade yesterday. Any one of them still showing strength that fresh trades could be initiated?
Well, fresh trade could be initiated in Motilal Oswal. It closed yesterday at 606. It's already, after posting low around, say, I think around 575 or so in the recent past, and then it has started moving up. So already into the upswing for 5 days. On the upside, 640 will be the first target. After that, 655. If it crosses 655, then it can move further up to something like 675 to 680. I'm giving these kind of targets because there are bullish crossovers in moving averages. And earlier you were talking about banks. I would say the bank that I could safely buy at the moment is PNB. PNB looks like it has shown a gap up open yesterday and moved up. It is going to scale up further. It could even go up to something like 140. Over a longer period of time, PNB might do pretty well.
All right. So that time of the morning where we get you the top brokerage notes, Harsh is joining us with more on that. UBS and Jefferies on BEL. I think, Harsh, that's what's on your list this morning.
Well, yes. In fact, BEL moved quite sharply yesterday on the back of numbers. Good, strong numbers. The guidance also seems strong, but just purely a couple of notes which have conflicting views, and that's why I wanted to kind of bring it out. UBS has downgraded BEL from buy to neutral. They seem to suggest that just in terms of valuations looks fully priced. Now target price 340, 6% upside from here. They're highlighting how the stock has rallied almost 150% over the last year or so, and this is largely because of the order intake, 70% larger or higher order intake coming through. They're expecting around a 19% top line growth and EBITDA CAGR of roughly between FY24 and 27 to be quite strong on the back of that stronger revenue growth. They're expecting EBITDAs largely to get maintained, but they just believe that based on 12-month forward valuations of around 48 times, this one is looking quite expensive and leaves little room in terms of, or bandwidth or wiggle room in terms of valuations, and therefore they believe that the medium-term growth potential is completely priced in, despite the 19% growth that it is expected to clock. They believe HAL presents a better opportunity in comparison just from a growth perspective over the next year or two. That's UBS's view. Jefferies bullish as ever. They've upped their target price 370 rupees a share, 19% upside from here. The order book, the kind of flow in terms of the order book, nearly 5,000 crore in Q1 FY25. The flow of orders continues to remain strong. According to them, revenue visibility is also strong, revenue guidance maintained. They're impressed with the EBITDA margin number on a year-on-year basis as well. So plenty of positives that they have brought out in their note. They've in fact hiked their EPS estimates by 2 to 3%, and they believe that exports should further push this higher. 9% of sales is what they believe exports will be at by FY30. So plenty of positives is what they highlight. Of course, more neutral stance by UBS, positive by Jefferies. They value it at 45 times September 26 valuations.
BEL in focus. UBS note is interesting because I prefer HAL to BEL. Quick take, we spoke about defense in a bit of detail, but Sunny, just specifically on BEL, the numbers on the face of it pretty good yesterday.
Yes, I think a pretty strong set of numbers from BEL sitting on a robust order book. Yes, as discussed earlier, valuations are something which have gone pricey for both BEL and HAL. But again, the return expectation has to be moderated. I think from a current juncture, 10 to 12, 13% kind of return over the period of next 6 to 12 months is something which one should expect. Then basis of new order inflow, which company will likely to execute during FY26, FY27 and FY28 period, maybe further leg of re-rating is something which we can see. But in short to medium term, I think the return expectations should be toned down. And maybe buy on dip is the right strategy in large cap public sector defense companies.
Buy the dips. in some of these names, but BL certainly. Well, at least Jefferies seems to be very, very constructive on this one. By the way, Kalpataru Projects has seen a bit of a downtick. Colgate has seen a serious uptick, 4.5% higher, 3348. As Jefferies' note suggested, third straight quarter of an EPS upgrade there. Not everybody is constructive, by the way. There is, I think, UBS or Nomura, which has reduced the target price too. But Colgate is doing very well. One of the exchanges, it's 4% as well. So, technically, Rajat Bose, if Colgate opens up this high, which is around 3,320 to 50 odd, whatever the number is there a trade existing in Colgate or would you avoid?
Say that if it were to open around 3,300, the target that I was told you a little earlier, and if it is opening at that level, I wouldn't be buying because I was expecting that it would move up. And if the prices move too far away from the upper Bollinger Band, that is the +2 standard deviation band of the last 20 days or so, then it will regress to the mean. So I would wait for a dip and then buy Colgate.
Would you, if you were an intraday trader, would you recommend trading some of those consumption names today? Colgate Palmolive is already doing well. In the last few days, consumption has been on a back foot. So today, since the sentiment is slightly more negative and Colgate has delivered, could an intraday opportunity sit in the consumption names?
Is this for me or Sunny?
It's for you. It's for you.
Okay. In that case, I would say that, see, if it opens that high, what you will see is that what people like me were expecting that Colgate would go to those levels, either people should book profits or they can go short, that kind of a thing I would suggest. At least not shorting because the stock has got a lot of bullish gumption, but book part profits kind of thing. But fresh entry at such a high level is not really warranted.
If I keep Colgate aside, I guess there is a missed opportunity there. But what about a Tata Consumer that hasn't performed? A GCPL that hasn't done too much in the last few days? ITC, I know, has had a pretty good run, to say the least.
Regarding Tata Consumer, it's a fantastic chart pattern. It's called rounded bottom or a saucer pattern, and now what is happening for the last 4 days, it is the cup and saucer pattern morphing into a cup and handle. The saucer is the cup and handle is being now prepared. This means that it will cross the upper high, the recent high around say 1240, that will be crossed and the stock will go further up. And this kind of a pattern is a very regular pattern, and this is a very reliable pattern also. So if since I have spotted a saucer, I would suggest that if you were to buy any consumer stock, Tata Consumer should be the stock if you look at it from a technical point of view.
Okay, so Tata Consumer from a technical point of view. Just Rajat, want to quickly get your views on a couple of counters that are moving smartly this morning. Let's look at Jindal Saw, let's look at a Zen Tech, and let's look at a Quess. All of them results play actually.
See, Jindal Saw, it's a buy. It's a buy simply because it has gone through a sideways movement since May. And now only it is breaking out and it is posting good results. So chances are that you will see Jindal Saw, at least from a technical point of view, the projection could be something like 675 to about 700 on the upside. And then the next question was Quest, you said, right?
Yes.
Quest Softec.
Quess Corp. Quess, Quess.
Quess Corp, this looks a little overstretched for the last 5 sessions. It has gone up from 600 to 740 kind of levels. So I would suggest that on a dip you can buy. And what is the level to watch out for? Will be 685 to about 695, but not at current levels. Because if you do so, already there are signs that there is a horn top already there. It may come down and then you will rue your purchase. But if you buy at a lower level, then it would be far safer. Put a stop loss below 670, buy around 685, 690. That would be a good thing.
Okay, that's some of the calls now. 15 seconds left for the markets to kickstart it. Remember, Asia is a bit soft, so you'll probably have not too many triggers for the markets to bump up, but seriously no concern for going down too much as well ahead of the big decisions that come out from global central banks and of course the big results from the S&P 500. So flat as flat can be for the large caps at least. The bank Nifty, the principal culprit yesterday, also looking flat currently. Mid caps and small caps should come up on your screen next and see if they are doing tad bit better. No, it's a flat move for the mid caps at least. The small caps, yep, almost flattish. Let's get the heat map up on the screen. Don't know how many stocks will be really moving, but let's mark nevertheless. Hindalco a bit soft, HDFC Life a bit soft. So metals seem to be slightly sluggish because there's a Hindalco, JSW and Tata Steel in the red. More red than green. Wonder if pharma is holding out. Divi certainly is, supplies, Reddy's is. So yet again, a day of positivity for pharmaceuticals. NTPC, couple of percentage points higher. Power Grid, couple of percentage points higher. I don't know if I missed a piece of news here, but yesterday was the results. The day before yesterday were the results. So you saw a bit of a reaction in those stocks yesterday itself, but some more upside there. And then the consumption names have a bit of an uptick. All in all, metals versus consumption and some bit of PSU flavor out there with BPCL, Power Grid and NTPC trading in the green. Well, large caps, that's the story.
Completely flat, actually. Not very exciting on the large cap side. Let's quickly look at what's happening on the broader markets end of things this morning. And definitely a bit more perked up relatively on the broader markets. That's the Nifty Mid Cap 150 for you. Let's quickly look at what's happening with small cap stocks. About 0.5% up. It's all about results in the first ticks of trade at least. So let's pull up some of those which are seeing a clear result impact. Kalpataru, HPCL, Maharashtra Seamless. If I put that in the first bucket, the results were less than positive, at least disappointing to what the street was expecting. And you're seeing that maybe play out. Kalpataru about 3.5% down. Profits and EBITDA margins have also slipped in this quarter. HPCL is the other one that we talked about. HPCL not half bad for the kind of profit dip because it was also expected to some extent. 1% down here. Maharashtra Seamless, again a weak quarter, and that stock is taking a beating this morning, about 5% down. Let's look at ACC, Colgate, Quess. So all of these actually all result impact that we're seeing. So ACC just mildly down. Let's look at Quess. Let's look at Colgate. These are some of the good numbers that came in. I would add a Jindal Saw to it. Colgate actually second consecutive quarter where they're seeing rural outpace urban in terms of revenue, and Colgate was up about 3.5%. We talked about Quess. It's a seasonally weak quarter, but they've done okay year on year. The numbers look good. About 0.5% up on Quess. Some of those pre-open gains completely disappearing. We spoke about Jindal Saw. Jindal Saw actually a good set of numbers. The stock is up 5%. So is Pfizer, about 3.5 to 4%. I'll just pull up an RVNL. RVNL, no numbers there, but order win that they have got about 739 crore rupees at the lowest bidder. That was a big run up on the stock yesterday. It's continuing its up move, at least in the first few minutes of trade. So these are some of the stocks on the radar, but I wouldn't say huge up move or a huge upside, at least at the start of day. So a bit careful still in the markets, and that's the broad mood.
Yeah, no runaway gains. Tamanna, the broader markets as well performing in line with the benchmark. The mid-cap and the small-cap index also trading slightly higher. The mid-cap index is up 0.5%. Small-cap index also seeing a 0.4% gain. And the micro-cap index also trading with a similar band. Bank Nifty is attempting to trade firm or higher this morning, but 51,473 is what we have on Bank Nifty. It is crumbling at higher levels very obviously. 51,000 is going to be important, followed by 50,800 on the support side. 52,000 on the upside is what bank traders will be tracking in today's session. Well, Tamanna has highlighted all the earnings reaction, but I'm just going to add a few to the list, which may not be earnings, but just good sort of performance coming in. Crompton is up 5%. Nuvama Wealth Management, which we talked about this morning as well, had a good run yesterday. It's up 70% in the last 6 months and continues its upward journey this morning as well. 3.5% on Nuvama is what we have. Suzlon sees a 4% uptick. Remember, late last week they reported earnings that beat street expectations by a mile, and the euphoria on the counter is evident even now. Adani Wilmar is up 2.5%. So anything in the consumption pack is looking good this morning. Numbers from Colgate were better than expected, and more importantly, the space has not participated in the last few days because it's been about risk on trade. This morning is all about catching up for consumer driven names. You've also got CESC that's up 4.5%. NTPC is up 2.5%. Real estate is doing a little bit of a comeback as that concerns around indexation have now seeming to be settled and absorbed by the market. Brigade is trading higher. RVN is having a good morning. Gujarat State Petronet is also trading firm. Well, you've also got KEI Industries that reported numbers yesterday. The street liked it. The counter does well in trade this morning. On the sell side, the top gainers are on back of earnings, but I'll just add a few to those lists. Excite Industries is down about 1.5%. Metals are taking a break. Zenzar is down 1%. Cement counters aren't looking too great either in morning trade. So all in all, it's lackluster. Muted. The index itself is trading flat, but there is some activity that is stock specific in the broader markets that's keeping the mid cap and the small cap index slightly higher in trade this morning. But let's quickly go over to, of course, we've already got a trading call coming in on a number of those names that we discussed this morning. But Rajat, anything else that you've spotted on market open?
Yeah, I would say that there is some bit of a possibility of showing up in the Zensa Tech, because the small candles actually it is a continuation sign, and chances are that it might move up from here and test something like 820 to about 840.
Okay, Zensa Tech is something that Rajat is liking. Rajat, there is an incessant up move in Suzlon. It's been 6 or 7 straight days of gains. Would you book profits here? It's up 3% yet again today.
A little earlier, you talked about Nuvama. Now, I would say that you look at the charts together, you will find Nuvama is even fiercer in its kind of move. So, my point is that if the move is already happening, let's ride the move, because it's not that right at the beginning it's circuit and then again next week, next day it is circuit. So one should carry on with a stop below yesterday's low.
Sorry, you're saying this for Suzlon, right, Rajat? A stop below yesterday's low.
Even if you are playing with Nuvama, the same thing.
Okay.
The same thing you should use. That yesterday's low would be your stop loss.
Okay, good, great. Okay, I have one question, Sunny. In the recent past, on which of the mid-cap names have you guys given a fresh conviction buy call? Is there one or two names? Are there one or two names that stand out?
Yeah, so sorry. So we have recommended Just Dial post this June quarter number.
Sorry, which one? Sunny missed the name.
Just Dial.
Just Dial and Fortis.
Yeah, no, only Just Dial.
Just Dial. Okay.
Just Dial. So a very pretty strong set of number during the June quarter. And what we believe is that there is still a lot of pricing gap in terms of tier 1 and tier 2, 3 cities. So the blended pricing comes to around 1580 rupees, and tier 1 cities stands at close to 2500 as compared to 1100 as far as tier 2, 3 cities are concerned. And I think with the push of government on MSME front, I think many MSME are looking at B2B platforms like Just Dial to increase their presence. So Just Dial is something where we have recently recommended buy on. In addition to that, Amara Raja battery, there we feel that again one of the key beneficiary, though that was a part of our budget pick, one of the key beneficiary of reduction in custom duty on lithium key minerals. And at the same time, their new gigafactory for lithium-ion cell and battery packs that has started functioning. So I believe that will start contributing significantly to the top line over the period of next 2-3 years. Yes, these are the two ideas which we have recommended recently.
Right. Sunny, we didn't discuss ACC with you. What did you make of those earnings? And if the stock gives an opportunity to buy today, would you initiate a position on ACC, Sunny?
ACC, I think very strong numbers as far as volume front is concerned, but I think the entire industry is going through the pricing pressure, and the impact of same was seen in on the ACC numbers. So I think compared to ACC, I would like to bet my money on Ambuja, which is again a same group company, and at the same time Ultratech, which is going through a lot of inorganic expansion. Recently forayed into the southern market by acquisition of India Cement. So I think for cement pack per se, I think maybe again a seasonally weak quarter. September quarter is a seasonally weak quarter for cement companies. And second half is a period where we will see a uptick in earning as far as the entire cement pack is concerned. If I have to pick one small cap company within the cement, then Star Cement, STAR, Star Cement, which is predominantly a northeast focused player, that is something which is under our coverage, and we are bullish on the name with a price target of 260 and investment horizon of 12 to 18 months.
Orient also had a fair bit of a run up yesterday as a list of companies which could be further acquisition targets, at least up in the green today as well. A few more buzzers this morning. RVNL up another 3%. Paytm has a press meet actually in a few hours from now, product launch perhaps that they're talking about. That stock is also doing fairly okay, about 3% up, and it's been a sort of a volatile kind of move for Paytm. Just Rajat, on RVNL and Paytm, any thoughts there?
RVNL has given a gap up open and now it is around 623. If it were to cross, say, 640 or so, then there would be a good move. But immediately, anybody looking for a short-term trade from here to 645 is a possibility, because the kind of movement that RVNL is showing it suggests that a lot of people are taking a fresh view in it. Fresh bullish view, so chances are that it can even go further up. Railway stocks yet, the bonhomie continues.
Right. Well, that's RVNL, 3% higher already in trade. Actually, Rajat, you want to comment on cement stocks? We didn't get a chance to ask you. ACC reported numbers. Do you have an opinion on ACC at all? Have you been tracking this one at all?
ACC yesterday showed a low of 25.25, and this low is posted after posting a high above 2,800, and that was early part of July, I think. So ACC is ripe for a change in trend, at least the short-term trend, where you can see 26.50 to about 26.75 for a minimum, if not further up. Since the results are good, I expect that it will cost 2,700 and move further up. If anybody is buying, as I was saying, that you can use yesterday's any range like 25.50 or something as your stop loss.
Okay, so that's the story with ACC. We'll take a very quick break at this point. Thank you so much, Rajat. Thank you so much, Sunny, for joining us. On the other side, we're speaking to the top team of Quess Corp management on their Q1 numbers and more. Stay tuned. Completely flat kind of a morning for the markets and a hunt for direction, I would say, is the kind of trend that we're seeing. The Bank Nifty not doing too much either. What's working on the front line? Well, you have a lot of result reactions coming in is what I would say. Look at NTPC. NTPC is actually the smart mover this morning. NTPC, Power Grid, even a BPCL. Although HPCL is hurting because of its numbers, but BPCL is doing okay. So you have some of this sort of PSU play coming to the fore. NTPC numbers were also decent, and you saw that reaction coming in yesterday, but you're having a second consecutive day of good numbers from, or a good result and stock impact from NTPC. Some of the defensives are also doing well. HUL, Britannia. Let's pull up a Colgate. Colgate has seen some smart moves, at least as soon as the markets opened. Have they sustained? Well, yeah, stock is up 6% now. So Colgate definitely doing very, very well. Quess is another one. Let's pull up Quess because we're seeing a lot of result reactions this morning. Quess Corp opened strong and it's about 4.5% up on the back of their quarterly numbers. In fact, we're speaking with the management right now. Guru Prasad Srinivasan, CEO, and Kamal Pal Hoda, CFO of Quess Corp, joining us now. Very good morning to you, gentlemen, and thank you for speaking with us here at NDTV Profit. Well, the year-on-year numbers look good. Quarterly numbers have seen a bit of squeeze on the EBIT margins and the EBIT as well. Is that a seasonal impact? Can you give us sort of an overview of the quarter? Let me start with that question to Mr. Srinivasan.
Sure. Thank you so much for having us on the show. Year on year we have grown by revenue 14%, and as we stepped into Q1 of FY25, it's been a fantastic start, and we have added about 30,000 by headcount in Q1 in itself, and this is sum total of what we have done in Q3 and Q4. So it's a good start. And the second call out is we have crossed about 5,000 crore of quarterly revenue. And again, a good milestone to cross, and consistently we'll move forward from here. And as we stepped into the year, our sales have been very strong. We have done about 160 plus acquisition of new customers with an ACV of 660 crores. So to your point, Q1 has some seasonal effect. It is by plan, and specifically comes from our GTS business. We have one of the business in our GTS platform, which is into specific for the BFSI segment in terms of collections. So they taper down a bit in Q1. And as part of our asset maintenance business, we do cater to food and beverage segment, specifically for university institutions. And due to the seasonal, close of vacation in institutions, that business actually tapers down a bit. And these two are high margin business, and this will have a seasonal impact in Q1. But as we step into Q2, they will start recovering back. So that's the trajectory for us to start with.
So, no, I get it. So, summer vacations has one impact as well. So, just to follow up on that, Mr. Srinivasan, then which is expected to be your best quarter? Because your PAT year on year is up 132%. What are the kind of margins you think you will see in Q2 and going forward?
So while we don't give a guidance on the margin, but if you look at our trajectory has been that we have been able to grow at anywhere between 12 to 14% year on year, and that we have demonstrated continuously. So with our best of quarters are normally Q2 and Q3 because being seasonal in nature. And of course, for few set of our businesses, Q4, like GTS is Q4 is good. So from that standpoint, I think we should be able to deliver online to our plan. And with regard to our margins, currently we are about 3.7%, and some about 20 basis points would recover as we move back into Q2 and Q3. And by end of FY25, we should be close to about 4%.
Srinivasan, why don't you tell us about the rest of FY25? How many new clients have you added across the board? And how sticky are these clients? Are they usually, recurring revenue that your company manages with these clients that you own? Or are these one-offs? And also the split between the global clients added and the local clients added?
Sure. So, most of our businesses are annuity, and we tend to sign any contracts between 1 to 3 years, and they continue in terms of recurring both revenue as well as the realization that we get from these accounts. And we have strengthened our sales team across both domestic and international geographies. If you look at the way we have started our Q1 in itself is a great start. And what happens is generally when in sales, what we acquire now will start delivering post H2 in terms of in its full form. So what we right now in Q1 and Q2 is largely what we would have signed between H2 of previous year. So from that standpoint, I think we are well slated for the year. The other attention that I would like to bring is the kind of the budgetary announcement which has been specifically the sector that we cater to, specific to skilling, employment, manufacturing orientation that has come into. That is going to also benefit a lot. Quess has to benefit a lot in terms of creating more freshers coming into workforce and employment. So which we have still not completely budgeted in our AOPs.
Huda, if you want to come in, Mr. Huda, and give me a sense of expansion, because historically you'll have gone out and acquired small companies, but there has been a lot of growth coming in from inorganic expansion. Is that the plan going ahead as well for FY25? What have you earmarked in terms of expansion, and how would you be looking to fund it?
Yeah, thanks for this question. So we've been, if you see last 3 years, we've been pretty much focused on organic growth rather than inorganic growth. Some of our past acquisitions have worked wonderfully well for us. But right now, as we've announced a scheme of demerger with a mirror shareholding, the entire focus is on getting the best out of the present set of operations and grow organically, and also work with the regulators and get the demerger process completed on time. So there are no plans of any active inorganic growth that we have for this year.
Okay. Now, Mr. Huda, looking at seasonality, and as we understood that Q1 might have a bit of a seasonality, but overall, things notwithstanding, with the leg up that the budget gives to skill hiring, plus the kind of cost pressures that you might be seeing, would you reckon that on an increased base, there is a probability of upping the performance on the operational metrics? Or do you believe that for a business like yours, whether for you or for your peers, this is about the margin set that you would maintain, and you would rather focus on growth as opposed to margins?
No, so the focus is on both. See, the growth, I think, is an opportunity right now, and especially like you mentioned, I think the budget has opened up those growth opportunities for all companies which are into this space. First time we have seen, announcements which are linked to formalization, linked to EPFO, bringing women into workforce. In India, as compared to other global economies, I think the share of women participation in the workforce. So there are specific announcements to get more women in the workforce. There are, in addition to the PLI schemes in manufacturing, there are ELI, employee linked incentive schemes for the manufacturing that we saw for the first time in the budget. So as far as the growth or the revenue targets are concerned, we are very bullish, and we hope that we'll be able to deliver better than what we had planned for this year. And as far as margins is concerned, as we explained, Q1 is a quarter where we experience seasonality for some of our high margin businesses. So we are at around 3.7%. We have clear visibility of taking this margin up to, crossing of 4% as we progress through the year. So the focus is on, the focus is on both the areas, growing volume as well as growing profitability.
Mr. Srinivasan, good morning to you. Long time that we've spoken, but I was wanting to understand what are the timelines for this demerger, and is there a base case of what's the kind of value unlocking that can happen? Is that the principal reason for this process?
Yeah, Niraj, thanks for that question. And, we are working towards that in terms of demerger a lot. If you look at, there are three elements. One, how are we strengthening our leadership as we move forward close to the demerger? How are we going to get our leadership strength and capability building? So that's one stream of work that we are doing. The second stream of work is this process generally take anywhere between 12 to 15 months. And we have already announced it. So as of now, it's progressing well. Everything is on track. So since our cases, we see it as largely it's a mirror shareholding. So there's no complication involved. It should definitely sail through well. And the other part is, why did we do even at this point in time? Because each of our business are at its position of strength. GTS is delivering about 17 to 18% EBITDA margins, and by size, they're almost about close to about 2,700, 3,000 crores. We have a clear path as to how we can take that business in a long term to $1 billion by size, and we have also strengthened the leadership, in that sector. Second, with regard to our workforce, it has been our signature business, and we have been growing very aggressively, and we have been bullish about India market. The way the investments are happening in India in terms of capex, and if you look at the latest retail FMCG consumption report, rural consumption has gone almost about 7.76%. It has beaten the urban consumption. So, which means it is also reflecting the way we are hiring people in tier 3, tier 4 cities. The demand also is coming from there. So, this business we are always bullish about, and we want to take this business to be globally number one in workforce. And with regard to our asset management, there's so much of capex investment happening, starting from infrastructure to public utility spaces, healthcare, and we see a lot of contribution or consolidation happening in that space. And it is also it's a volume come value business for us. And I mean, we have substantial revenue close to about 3,000 crores coming in from there. And this business will do well as infrastructure grows well. So sheer from position of strength, each of them are in the right place for us to, put them into individual independent listed companies as and when the legal process completes. So we are quite happy the way the unlocking would happen as we move forward.
Is there a timeline in mind for this process to be completed, or it's a wait and watch, Mr. Srinivasan?
So it will take about 12 to 15 months, as I said. So we are, we have already filed, so probably bit of next year by this time, we should be definitely there.
Just want to get a trend check, and let me come to Mr. Huda on this question. I just want to understand what is happening with ITES. The commentary we're hearing tells us that there is an initial sort of an uptick in hiring in this space. Are you seeing it as well? Can you give us some color on what your expectations are here?
Yeah, sure. So, see, we are seeing that as well, some green shoots. So the open mandates are up 36% as far as the IT business is concerned. So it used to be around 1,000 to 1,100 positions. We are seeing right now around 1,400 positions in the IT hiring space. And within that, our share on hiring has been more focused towards GCC. So, almost 70% of the open mandates that we are working is towards GCCs, which are high margin businesses for us. So, and if you follow the results of all the IT companies which have recently come, they've also started hiring. So yeah, it's all looking that the IT hiring should be back, and that should also further boost our profitability and margins.
All right. Okay. So green shoots in ITES, that's good news, definitely. Thank you so much for joining us, Mr. Srinivasan and Mr. Huda. We're speaking to Quess Corp management there. We'll take a very short break, and the other company on our radar on the other side is Zen Technologies. Ashok Atluri, the CMD, will be joining us. Stay tuned for that.
Welcome back. You're watching India Market Open. The general market seems to be quiet, largely on expected lines. Global cues are muted. And of course, yesterday's kiss and miss of 25,000 has got the bulls back in check. But we have with us one company that has outperformed on every front and does this quarter on quarter, to say the least. It's talking about Zen Tech. It went home with gains of 5% yesterday and continues to trade higher in a rather muted market. Ashok Atluri, CMD of Zen Technologies, now joins in. Hi, Ashok. It's Samina joining in from NDTV Profit. Congratulations once again. It's been a historical quarter for Zen Tech. You know, we are so used to talking to companies who deliver double-digit growth in the range of the 20s and the 30s. You've pulled out a 92% growth on revenue. Profits are up 65%. Margins have improved. EBITDA has gone up significantly. Key highlights and whether this sort of growth is sustainable going ahead.
Thank you so much, Samina. So, I think we started on a smaller base, so the growth has been tremendous. If you look at from 60, we did 160 crores, 160 to 430, but now it's, now we are in the 100% range, 432. We are saying that we'll do about 900 crores this year. And, going forward, we are, giving a more muted projection of 50% CAGR on an average basis for the next 3 years. So I think, yes, but again, I think the ground reality is much, wilder than if these figures look wild. The ground reality is much wilder than this. The government of India is going hammer and tongs, and behind the Indian company and saying, listen, we want this, we want that. We have to really scale ourselves up to the requirement that they have. So I think people with the ground to the ear at the MOD and the armed forces, they really know that, this is just the beginning of a very, very long haul procurement process. A lot of things to be procured, and it's we who have to scale up for the requirements.
Look, I know there are multiple businesses that you focus on. One is training, the other is simulators. But before we go into the product, and you've also, I believe, launched a few products this quarter, break your revenue between domestic and global. So how much and how well has the exports done for you this quarter, and the outlook for FY25?
So the outlook, we are going to do 900 crores in total. And we think out of the 900 crores, 300 crores plus would be exports, and the rest would be domestic. And for this quarter, we haven't done any exports. The exports will come in the forthcoming quarter. All the turnover has been domestic only, with about 100 crores for anti-drone systems and 145 crores for training and simulation in the training and simulation segment.
Mr. Atluri, good morning. Niraj here. This order inflow, which has been a trickle, is it because of it being an election quarter, or are there some order deferrals that will come in quarter 2 and quarter 3?
So what we had projected last few quarters is that we will get the orders in the third, starting from the third, but more heavily in the fourth quarter. And the trickle of order was expected. It was nothing unusual in this, but we think usually this government-related projects are heavy on the fourth quarter. And of course, elections did play a part in slowing down the order thing. But we think that starting third quarter and especially in fourth quarter, we'll get the order, trickle will get into a, more pouring or a flood kind of thing.
Pouring or a flood. I love those words, Mr. Atluri. The second question really is, you've done 250 crores already. Are you being conservative when you talk about 900 crores? Or will it get balanced out in the subsequent quarters? It's great to underpromise and over-deliver. Just trying to think if you're doing the same.
I think it was a realistic target.
But you've done 250 crores, sir, in quarter 1.
Yeah, so again, it's an existing order book position, so we are executing it much faster than we had born. So again, my thing is that on the overall year, we would be doing about 900 plus crores. And the quarter on quarter may vary a bit. So don't expect the next quarter to be bigger than this quarter, or the next quarter to be smaller than. So, but we'll try to definitely touch the 900 crore target we have. And maybe we may exceed it by, a few crores.
Mr. Atluri, good morning. Tamanna here as well. Just trying to understand, among other things, you've talked about in your conference call new products to open up revenue streams. Just give us a sense of which directions you're looking at. I mean, obviously, simulators and anti-drone systems are the two big parts of it. What else are you seeing?
So the two streams here, I think again they may be anywhere between 40 to 60% the contribution. As of now, it's heavy towards simulators. But we think anti-drone systems are also coming into their own, and there's a lot of demand being created. So we expect sales to be recorded in that. But now we have launched another group of products, especially this autonomous surveillance systems and site systems. So with this surveillance and site systems and the autonomous, like the robot dog that we have launched, we expect some traction to come in the next year. Even though this year we have started recording for the anti-drone system, we integrated one of the cameras and it worked very extraordinarily well. And, we scouted a lot in India and abroad for that. But finally, we found a company that was delivered the system that really well integrated with our anti-drone system, and we invested we took 51% stake in that company. So we expect that this will start in the next year, the stabilized side, the artillery side, and the robo-dog and the remote control weapon station. So this is a very big thing, the remote control weapon station, where it's ultra light. We had earlier, which was 250 kilos and almost required a crane to move around. But now the team has come up with something which is sub 40 kilos, can be moved by hand, and it's very portable. Basically, you don't have to expose yourself. You can just put the gun there and you can put it on a gypsy, and you can be completely inside a bulletproof thing, and you can keep controlling through a joystick and a trigger the operations. So this actually takes the soldiers out of the harm's way, and I think this is going to be very big, and we expect next year onwards, a lot of this third revenue stream to become active.
To what extent, Mr. Atluri, and I have to ask you about this robo-dog. It sounds fascinating. What does it do?
So it's basically, it's a quadruped. I mean, it's a four-legged dog, and you can, in fact, the video is there on my website. So you can put a gun and you can transfer it, its payload, it can lift as much as 70 kilos. So, but the one we have is, somebody wanted, the gun loop to be loaded and the robot to climb up, jump obstacles and all. So all those things the robot is capable of doing. And so again, I would be very happy to share the video link with you.
Yeah, that sounds pretty exciting. Very lastly, Ashok, also margins have improved significantly this quarter. I think from what we saw last time around to this time, it's about, no, actually they've declined. Your margins have come in at 44 versus 52. What is the reason for the decline in the margins, and what range are you targeting for the rest of the year?
So, again, it will depend on the product mix and the market mix. If the exports, we have higher margins than the domestic market. Then in simulators, we have higher margins than the anti-drone system. Within simulators also, there is a wide range of, margins that we have, depending on various aspects. So, but again, we have promised that the target will be around 35% EBITDA and 25% PAT on our turnover.
Okay, sorry, Mr. Atluri, is this something that you believe in the foreseeable future? Because your last 2-3 years CAGR has been a way stronger than your last 10 years. And I've heard you say that the next 5 years will eclipse what you've done in the previous 10 years. So I'm just trying to understand, beyond FY25, wherein you will double your revenues, what's the realistic run rate, sir?
So, internally we have discussed, and, we have said that on an average, again, 1 year may be less, 1 year may be more.
Yeah.
But on average, we will attain a CAGR of 50% at least. That's our target, and we are hoping to stick to that.
So 50% revenue CAGR while presumably maintaining margins and return ratios.
Absolutely, yeah. The margins are also on the conservative side.
So 40-44 is the conservative margin number, and you will also maintain your return on capital, etc., because that is also a healthy 44-45, if I'm not wrong.
Yeah, we have set PAT of 25% and EBITDA of 35%.
35%, okay.
And Mr. Atluri, just to take from Niraj's point, where will that growth come from? Because, of course, currently you're growing in this space because of a low base. Will it be new product launches? Is there new IP that you're sitting on or working on? Because I know you're big on R&D as well. Will it be training? Will it be a global order book? Where is that chunk of growth going to come from in the next 3 to 5 years?
So, both the anti-drone systems and the simulators have just been started being procured by the Indian Armed Forces, and even worldwide, except in very advanced countries, in smaller countries, this simulators concept has not been there. But thanks to the, Ukraine war, where, Ukraine has world's most advanced equipment, but they are losing against a country that has all 20th century equipment, is being, the reason as the predominant reason is being said that they have not been trained enough. So training has suddenly become very, very important. And anti-drone system threat is just emerging. People are becoming alive to it. So they are also starting from a very, very low base. Almost, I would say in India, we might have not even fulfilled 5% of the simulator market, and a drone market, we think maybe less than that. So there is a huge scope in these two segments itself in India and world over. So because it's not yet even partially fulfilled. Even, maybe I would say about 5 to 6% of the demand is fulfilled. So there is a huge growth in they also start from a very low base, and huge growth prospects in both these segments. And the new one, the Sight and the RoboDog and the remote control weapon station are very, very big. I think they are also going to create an additional revenue stream for us.
All right. Thank you so much, Mr. Atluri, for speaking with us. Always a pleasure. A lot more to talk about, but we have run out of time. Zen Tech in focus, and yes, they have had a great quarter. More revenue streams also on the anvil, which could kick in from Q3. With that, it's a wrap on India Markets Open. But stay tuned. Talking Point up next.